Thousands of SpaceX employees became millionaires overnight. But there was one problem: they couldn't spend their new fortune. After the company's historic IPO, billions of dollars in employee shares were locked away. Why create life-changing wealth, then stop people from cashing out? The answer reveals a strategy that shapes every major IPO. June 12, 2026 became one of the biggest days in financial history as SpaceX finally entered the public market. After years of remaining private, the company opened its doors to investors around the world. Demand exploded almost instantly. Investors rushed to buy shares in the world's leading private space company, pushing the stock sharply higher during its first trading sessions. Headlines focused on Elon Musk, but thousands of employees were experiencing a life-changing moment of their own. Engineers, technicians, factory workers, and support staff suddenly saw the value of their company's shares rise to extraordinary levels. On paper, many had become millionaires overnight. But there was one major problem. Their wealth existed mostly on a screen, not in their bank accounts. Owning valuable stock is very different from having cash you can actually spend. Liquidity, not wealth, became the biggest challenge. The celebrations were real, and the fortunes were real, but most employees could not immediately sell their shares. Only a small percentage of SpaceX stock was available for public trading. This limited supply, known as the public float, created intense demand and helped drive the share price even higher. Behind the scenes, however, a carefully designed lockup agreement prevented most insiders from selling their holdings. Public investors could buy and sell shares freely. Employees could only watch the market move while their ownership remained locked. That wasn't a mistake. It was part of a deliberate financial strategy created long before the IPO. The real story isn't just about becoming rich overnight. It's about why billions of dollars in employee wealth were intentionally frozen, and how one unusual lockup system helped shape one of history's most remarkable public offerings. The biggest surprise wasn't the IPO itself. It was the rules that determined who could actually sell their shares. While headlines celebrated overnight millionaires, most employees quickly discovered that their new wealth was temporarily out of reach. The reason was something called a lockup period. This is a contractual agreement that prevents company insiders from selling their stock immediately after an IPO. The purpose is simple. If thousands of employees sold at the same time, the sudden flood of shares could overwhelm buyers and drive the stock price sharply lower. Most public companies use a single lockup period. After a fixed number of months, insiders are free to sell their shares. SpaceX, however, reportedly followed a different approach. Instead of releasing every share at once, the company introduced a staggered schedule with multiple release dates spread over time. Only a small percentage of total shares entered the public market during the first trading sessions. That limited supply, known as the public float, remained far smaller than investor demand. Scarcity pushed prices higher because buyers were competing for a relatively small number of available shares. Additional shares would become eligible for sale only after specific milestones arrived. Some release windows were linked to quarterly financial reporting periods. Others were tied to employee compensation plans and long-term corporate objectives. The goal was to increase supply gradually instead of creating sudden selling pressure. For employees, however, the situation became more complicated. Their fortunes continued growing on paper, but most of that wealth remained locked inside company stock. They could watch the value rise every day, yet still had limited access to the money itself. Then, another challenge appeared. Taxes, vesting schedules, and financial planning suddenly became just as important as the rising share price. Before anyone could spend millions of dollars, they first had to understand one of the most misunderstood parts of employee ownership. Most SpaceX employees didn't receive enormous cash bonuses. Instead, a significant part of their compensation came through company equity. As the business grew, those shares became one of the most valuable parts of working at SpaceX. Like many technology companies, SpaceX rewarded employees with restricted stock units, or RSUs. These are not shares employees own immediately. Instead, they become available over time through a process called vesting. The longer employees remain with the company, the more of those shares they earn. When SpaceX's valuation surged after the IPO, many vested shares suddenly became worth far more than anyone expected. Overnight, thousands of employees saw their net worth increase dramatically, but that new wealth also introduced a challenge that many people never think about: taxes. In many situations, taxes can become due when equity vests, even if employees have not sold their shares. That can create a difficult cash flow problem. Someone may appear wealthy on paper while having limited cash available to pay taxes or other financial obligations. The exact outcome depends on each employee's compensation package, local tax laws, and personal financial situation. That is why experienced financial planning becomes just as important as the shares themselves after a company goes public. Another important decision is timing. In some tax systems, holding qualifying investments for longer periods may reduce the overall tax burden compared with selling immediately. For many employees, patience can sometimes produce better long-term results than rushing to cash out. The company also had another reason for slowing insider sales. Releasing shares gradually helped protect market stability and reduce the risk of sudden selling pressure. Many executives and large shareholders also follow prearranged trading plans instead of reacting emotionally to daily price movements. Experienced investors understand that the stock price tells only part of the story. Trading volume, public float, and the gradual release of insider shares often reveal much more about where a newly public company may be heading next. For investors, the biggest question wasn't when employees could sell their shares. The real question was how those future sales might affect the entire market. While many expected one massive unlock day, SpaceX reportedly followed a much more gradual approach. Releasing every insider share at once could have flooded the market with supply. If too many shares become available at the same time, prices can come under heavy pressure as sellers outnumber buyers. By spreading those releases across multiple dates, the market has more time to absorb new shares without creating unnecessary volatility. Professional investors pay close attention to more than the share price. They study trading volume, liquidity, and the size of the public float. Healthy liquidity allows buyers and sellers to trade efficiently while reducing the risk of sharp price swings caused by limited supply. As additional shares gradually enter the market, investor behavior often changes. A growing public float can improve liquidity, attract larger institutional investors, and create a more stable trading environment over time. That is why experienced analysts rarely focus on a single unlock date. They monitor the entire release schedule and how supply evolves month after month. Large shareholders also prepare carefully before selling. Many executives and early investors use prearranged trading plans that automatically schedule transactions over long periods. These systems reduce emotional decision-making while preventing sudden waves of insider selling that could unsettle the market. It is also important to remember that insider sales do not automatically signal bad news. Many employees sell simply to diversify their investments, purchase a home, pay taxes, or secure their family's financial future. Personal financial planning is often the real reason behind those decisions. For SpaceX employees, every future release date represents a deeply personal choice. Should they sell immediately, continue holding their shares, or build a completely new long-term investment strategy? That decision may shape not only their financial future, but also the next chapter in one of the most remarkable wealth creation stories in modern business history. As lockup periods gradually expired, thousands of SpaceX employees faced financial decisions that could shape their futures for decades. Contrary to popular belief, most employees don't automatically sell all of their shares the moment restrictions are lifted. Many financial advisors recommend diversification, reducing the risk of having too much wealth tied to a single company. When both your paycheck and your investments depend on the same employer, concentration risk can become significant. Selling part of a position can help balance a portfolio while still allowing employees to benefit from future company growth. Others may continue holding because they believe SpaceX's biggest achievements are still ahead. Supporters point to ambitious projects like Starship, satellite internet expansion, and future space exploration as reasons for their long-term confidence. Some employees choose to sell only a portion of their shares while keeping the remainder invested for the future. For many families, unlocking shares creates opportunities to pay off mortgages, eliminate debt, build retirement savings, or fund their children's education. Once life-changing wealth has been created, protecting it often becomes more important than chasing every possible future return. Emotional decisions can be costly, which is why experienced investors usually rely on disciplined, long-term financial plans instead of short-term market excitement. Financial planning involves much more than watching a stock price. Taxes, diversification, personal goals, and future obligations all influence the best decision. Every employee's situation is different, meaning there is rarely one perfect strategy for everyone. Because shares are released gradually, employees can spread their decisions across multiple lock-up windows instead of acting all at once. That flexibility allows them to respond thoughtfully as market conditions and personal circumstances change over time. In many ways, the lock-up period wasn't simply delaying access to wealth, it provided time for employees to make careful, informed decisions. SpaceX isn't the first company to structure insider ownership this way, but the scale of its employee wealth creation attracted worldwide attention. Many of history's biggest technology companies used similar approaches to prevent sudden waves of insider selling after going public. To understand why SpaceX followed this strategy, we need to compare its IPO with some of the most famous public offerings in modern financial history. SpaceX's strategy becomes easier to understand when viewed alongside the biggest public offerings of the past 2 decades. Most companies that go public impose a single lockup period, preventing insiders from selling shares for several months after the IPO. When that restriction expires all at once, markets can suddenly face a large wave of selling, creating uncertainty and increased price volatility. SpaceX reportedly chose a different approach by spreading potential insider sales across multiple release windows instead of one major unlock event. Gradual releases give the market more time to absorb additional shares without overwhelming normal trading activity. This approach reflects a philosophy the company has followed for years, building long-term value rather than focusing on short-term market movements. Predictable release schedules also help investors better understand when additional shares may enter the market, reducing unexpected surprises. Professional investors often combine these release dates with earnings reports, cash flow, and business performance before making investment decisions. As more shares gradually enter circulation, trading typically becomes deeper, more liquid, and more efficient over time. It's also important to remember that insider selling doesn't automatically signal bad news. Employees may sell shares to buy homes, pay taxes, diversify investments, or secure their family's financial future. Long-term company value ultimately depends on innovation, execution, revenue growth, and operational performance, not simply on insider transactions. Strong business results usually matter far more than temporary changes in the number of tradable shares. What makes SpaceX unique isn't the existence of lockup periods, but the reported structure designed to release ownership gradually while supporting market stability. Even after one release window closes, additional milestones still lie ahead as more shares become available over time. Investors will continue watching ownership changes, liquidity, and company performance as the public float steadily expands. But beyond stock charts and trading volumes lies a much larger lesson. This story isn't really about selling shares. It's about how visionary companies create lasting value, reward the people who helped build them, and protect that value through disciplined long-term planning. Behind every stock chart is something far more important, a story about ownership, patience, and the creation of long-term value. Owning valuable assets and having immediate access to cash are closely connected, but they are never exactly the same thing. Paper wealth reflects the value of what you own, even if those assets haven't yet been converted into spendable money. Many of history's greatest fortunes were built not through constant trading, but through years of patient ownership and disciplined investing. SpaceX's long-term vision reminds investors that transformational companies often think decades ahead rather than focusing only on the next quarter. Employee ownership also creates powerful incentives. Aligning individual success with the long-term performance of the company employees help build every day. Temporary restrictions may seem limiting at first, but they can strengthen the foundation for sustainable growth and market stability. Different investors will always reach different conclusions, yet informed decisions should be guided by facts instead of emotion or speculation. Today's ownership structure is known. Tomorrow's market performance, however, will always remain uncertain. Stock prices respond to innovation, financial results, competition, economic conditions, and investor confidence, not simply insider selling schedules. Ultimately, SpaceX's future value will depend on how successfully it continues executing its ambitious mission. For thousands of employees, those shares represent years of dedication, late nights, technical breakthroughs, and belief in a vision that once seemed impossible. Their wealth was created through ownership, patience, timing, thoughtful financial planning, and years of disciplined execution. The SpaceX IPO may become one of the defining financial events of this generation, but its lessons extend far beyond a single company. Innovation creates opportunity. Ownership creates wealth. Patience often determines who benefits the most. Perhaps that is the greatest lesson of all. The real measure of wealth isn't simply what you own today, it's what you continue building for tomorrow. And in the end, SpaceX's story reminds us that extraordinary companies don't create value overnight. They create it gradually, through vision, execution, and the patience to think further ahead than everyone else. Let's return to the question we asked at the very beginning. Why couldn't SpaceX employees immediately spend their newfound wealth? The answer comes down to ownership, timing, and how public markets work. First, most employee shares remain subject to carefully structured lockup agreements after the IPO. These restrictions prevented insiders from selling everything immediately, helping create a more orderly transition into the public market. Second, shares were reportedly released in stages, rather than all at once. By gradually increasing the number of tradable shares, the company reduced the risk of overwhelming the market with sudden selling pressure. Third, every employee's financial situation was different. Taxes, vesting schedules, personal goals, and long-term planning all influenced whether selling immediately made sense. For many, protecting wealth became just as important as creating it. The result was extraordinary paper wealth, but not necessarily instant cash in the bank. As time goes on, investors will continue watching trading volume, future share releases, company performance, and overall market conditions. Yet no one can predict exactly how the stock will perform in the years ahead. What remains clear is that SpaceX's ambitions extend far beyond its first day as a public company. Its future will ultimately depend on continued innovation, successful execution, and the ability to achieve goals that once seemed impossible. For thousands of employees, those shares represent far more than a financial investment. They reflect years of hard work, late nights, technical breakthroughs, and belief in a mission larger than themselves. This story reminds us that lasting wealth is rarely created overnight. It is built through ownership, patience, thoughtful planning, and long-term commitment. In the end, the most valuable asset wasn't simply the stock, it was the vision, innovation, and perseverance that made it valuable in the first place. Ahead than everyone else.